Hey friends, I want to share with all of you 5 of the most important dividend stocks that I own. These 5 dividend stocks are crushing their earnings and they are rewarding shareholders right now, even though our overall economy is really rocky. Interest rates are going up. There's bad news on the TV almost every day. Despite that macroeconomic backdrop, this winner-takes-all society is rewarding these 5 dividend stocks that I want to share today. I want to start with PepsiCo. Check it out on the screen right now. You can see their Q1 earnings report here. Year over year, revenue is growing 10.2%. Their EPS is growing 18% on a core constant currency basis. In fact, their organic revenue growth, by the way, is up 14.3%. We live in a society right now, in my opinion, that is winner takes all. And the most core quality blue chip companies, dividend stocks like PepsiCo, they are doing all right, even though interest rates are going up, even though you hear about layoffs in the news, even though the Federal Reserve is putting our economy potentially in a rocky position. We're seeing banks starting to fail. There are quality dividend stocks like PepsiCo that are doing just fine. In the video today, I want to share why dividend stock investing works so well for me as someone that wants to build huge cash flow over long periods of time. In fact, I've been in PepsiCo since 2011. As you can see on the screen right now in front of you, I want to share some metrics from PepsiCo and also some history with my investment in PepsiCo. And I have 4 other stocks that I want to share today as well. You can see on the right-hand side of the screen, I started buying PepsiCo in 2011. I started buying it at $63.78. It's now at $194.26. I have an unrealized gain on just an equity standpoint of 204.6% on that first tranche. Now, what's so exciting is the dividend yield right now. You can see on the left-hand side of the screen, it's 2.6%. It's pretty low. And that's because the stock has appreciated so much, and that's the starting dividend yield. You can see the PE ratio on the left-hand side of the screen. It's in the mid-20s. It's kind of high now because one of the things I've learned about the stock market is when there's good news, it tends to overreact to the upside. When there's bad news, it tends to overreact to the downside. There is some really good news about PepsiCo right now, so it has overreacted a little bit to the upside. I would say that this stock is richly valued. I wouldn't say it's too overvalued, but it's rich. It's rich and fairly valued. As you can see on the screen right now, what I want to share about PepsiCo is that the 5-year dividend growth rate is 6.4%. The most important thing to realize on this screen is that this company increases the dividend on average by 6.4% for the last 5 years. And so what's exciting, going back to the right-hand side of the screen, is if I take my current dividends per year per share from this stock, which is $5.06, and I divide that into my first tranche purchase price of $63.78, my simple yield on cost on the first tranche, not even counting reinvested dividends, is almost 8%. This is why dividend stock investing works. The company has flourished over the years. Each year it is compounding and growing its earnings, its revenue, and over the years it has passed some of those earnings down to shareholders like myself as dividends, and those dividends increase over time only because the earnings are increasing over time. They pay out based on the success of the company. And so I'm up at almost 8% on that first tranche versus a starting yield for someone buying net new today of 2.6%. That's why dividend stock investing works. One of the reasons, at least. I like looking at my PE ratio on cost as well. If I take my $63.78 first tranche, I divide it by the 2023 EPS earnings per share estimate of $7.32, I get a PE ratio on cost of 8.71. And so the current PE is in the mid-20s, but my PE on my first tranche is 8.71. Now, worth noting, I was buying this thing in 2022. I added heavily in the $170 range. It felt expensive at the time, but I bought quality. I knew I was going for quality, and quality is being rewarded because this company is growing. The stock price is even higher than when I bought it in 2022 at that $170 range. You can see the chart. It's up and to the right. Of course, it has peaks and troughs. And the reason for that is there's going to be good news and bad news over the years. It's going to overreact on good news, overreact to the downside on the bad news. But quite frankly, over long periods of time, when you really zoom out, it is being rewarded in a winner-takes-all society as an operation of scale. And this is why I invest in quality dividend stocks, because no matter what's happening out there in the world, times are getting tough, recession is bad, everyone needs salty snack foods to survive. And I like to invest in PepsiCo for their Frito-Lay brand. I want to keep going though, because I have 4 more stocks to go through today, 4 more earnings reports, which are really exciting. The next one I want to share is McDonald's. As you can see on the screen in front of you right now, McDonald's is another stock, another company that just absolutely crushed their earnings. And so you can see that in the first quarter of 2023, comparable sales increased 13%. How amazing is that? 13% sales growth, and that is in constant currencies, and that's system-wide. The reason it's important to look at this is some of the stores are operated by McDonald's. Some of the stores are operated by franchisees. When they say that system-wide sales in constant currencies is up 13%, that's looking at everything. That's looking at all of them. And what I really like seeing here is boy, this is almost extraordinary, but you can see diluted earnings per share was an increase of 72% in constant currencies, but it looks like there was some one-time accounting restructuring there. And so if we go all the way to the bottom, it's an increase of 19% in constant currencies. And so 19% growth, constant currencies for a mature company on earnings per share like McDonald's. Again, I think there's this misrepresentation out in the market sometimes that a big company, a mature company, it can't grow anymore. It's already at a large scale. But I think what's happening in our world with these high interest rates, with the complexities of modern business, is actually the biggest companies are rewarded. It's a winner-takes-all society. And that's why I like investing in these blue chip dividend stocks. I want to keep going with McDonald's because, as you can see on the screen now, I have a metrics breakdown like I did for PepsiCo. And I want to go through just a few exciting metrics with McDonald's. And so we have it there again, revenue growth, constant currency. I have the adjusted EPS growth, constant currency. We just saw those on the last slide. Just that adjusted EPS growth, I cannot even believe that, 19%. How amazing. Just like PepsiCo, it's only 0.8% off its 52-week high, so it's basically trading at a 52-week high. I would say the news has been so good on this company that perhaps it's overreacted a little bit to the upside on this good news. And if it had a weak earnings report, perhaps it would overreact on the downside. You can see on the chart it's up and to the right, but there are peaks and troughs, and so that's why I like to invest for very long periods of time, because it smooths all of this out. And what I really am excited and I highlight on this slide is the 5-year dividend growth rate is 8.5%. So on average, it's growing the dividend by 8.5% per year. The only reason they can do that, I think sometimes people don't fully realize, where do dividends come from? How do they keep increasing the dividend? The dividend comes from earnings, and they can only increase the dividend if earnings grow. And that's why I love looking at these earnings reports. Now, my first tranche analysis in 2011, I bought it at $73.53. And so I have an unrealized gain from an equity appreciation standpoint on that first tranche of 303%. And my simple yield on cost on that first tranche is over 8%. And so starting yield, again, it's only 2%, but because I've been in this a long period of time and I've held it through all of these years of earnings growth and dividend growth, my yield on cost on my first tranche, not even counting reinvested dividends, is 8.3%, and my PE on cost is a staggering 6.6. I have a staggeringly low 6.6 PE on that first tranche. And so what's funny is earlier this year in February, I added more McDonald's. I shared it over on my Patreon. I'll link to that in the pinned comment below. I share my stock trades on Patreon. And I added it $269. And many investors were believing at that time it was overpriced, overvalued. I followed, though, my own analysis and intuition. I believed that, yes, it was fairly valued, but I was taking a Warren Buffett approach. One of my strategic charters for this year is all about quality. It's putting my money in the highest quality core stocks. And because I followed my own intuition, I knew I was buying at fair valuations, but I also knew this company was growing, I was taking a Warren Buffett approach. He far prefers buying stocks at fair valuations that are really quality companies versus buying companies that aren't quite as high quality, but at really cheap valuations. He prefers the first versus the latter. matter. And that's what I prefer as well. I prefer to buy quality, especially in tough times and turbulent times. I need to rely on quality to navigate turbulent times. And McDonald's is this, and I'm being rewarded already, even though I paid full price back in February. So that's McDonald's. By the way, if you enjoy the video so far, please go ahead and click that like button. It means the world to me. And if you own McDonald's or PepsiCo, put in the comments below, what do you think about these stocks? What do you think about this quote unquote winner takes all economy that we're in right now? Do you think these stocks will continue to flourish, these companies, their earnings, and therefore the dividends? Or do you think a really tough economic event is right around the corner? I think even if there is a bad economic event, everyone needs to eat, and everyone loves eating McDonald's and PepsiCo as well. And as long as we're talking about food, I want to talk about Starbucks next. So as you can see on the screen in front of you, Starbucks is another one of my favorite dividend stocks. It's my largest position at this time. And I want to share what is going on with Starbucks, because when they announced their earnings, it actually, I thought, was really good, but the stock tanked. So let's take a look at this. Now, worth noting, it tanked the day the earnings were announced, but now subsequently it's been coming back up again. And so this is a little bit of an interesting one, but we see that the consolidated net revenues are up 14% year over year. We can see comparable store sales up 11% globally, 12% North America, 7% international, and we can see that the rewards members are up 15% year over year. But what's most important with all of this, quite frankly, is I need to go all the way to the bottom of this report, and it shows that the non-GAAP earnings per share grew 25% year over year. 25%. Let me repeat that again. Starbucks is a mature company with, I believe, I'm just going off of memory here, but I think about 36,000 stores across the world. This company right now, when people were telling me just a few months ago, just a year ago, no one's going to pay for this quote unquote overpriced coffee. Well, people are paying for that overpriced coffee, if you will, because earnings are up 25% year over year, and I'm one of those customers. I'm there more often than ever before. I love it. Thug life. But let's look at this. Check it out on the screen right now. Starbucks. Again, I want to reiterate, the revenue is up 14% year over year, but the adjusted EPS 25%. Now, the price per share is at $107. The 52-week high is $115. It's down 7% from the 52-week high. A lot of people were getting worried on this earnings report because, oh my goodness, it was down like 9% in one day. But the reason it went down 9% in one day is this stock was trading at a 52-week high. This stock, I would say, is already priced to perfection, and there was no revised upwards earnings guidance. So in this report, no matter how good it was, they didn't say, hey, we're raising our EPS range for the year. They didn't do that. They didn't feel comfortable doing that. Because of that, it was down 9% in one day. It's already rebounding back up. It's only 7% off the 52-week high. I think a lot of people read into this too much. The way I read into it, quite frankly, was the fact that, look, it's already trading at a 52-week high. It's already trading at a forward PE in the 30s, and it was probably a bit frothy, if you will, a bit maybe overvalued, if you will. And so I think it was a little bit of, the news was good, but it's already at a 52-week high. And so what are these hedge funds and mutual funds to do? I think they're just rebalancing. Anyway, I love the news. I think it was good. I am holding really strong. I want to add more, so I hope it goes down below 100, but I don't think it will. Their 5-year dividend growth rate is 12%. Worth noting, I was buying this thing heavily, very heavily in 2022 at $80 a share. And this is when the skeptics were saying no one would pay for overpriced coffee, quote unquote. I don't think it's overpriced. I think it's cheap. I think it's cheap coffee. And the reason I think it's super cheap coffee is for the price of a coffee. What is it, $5 or $6 these days? I can sit down there in Starbucks all day and use their Wi-Fi and use it as my office. And so that's the cheapest office in all of America in times where rental rates for anything in commercial real estate is expensive. And so I look at it as cheap coffee, but I guess I'm a contrarian. But as you can see on the screen in front of you right now, what I want to share on Starbucks on my first tranche analysis I haven't even been in this thing that long. I've made it my number one position, only starting out in this since 2017. But my first tranche was at $58. My unrealized gain on that first tranche is 81.9%. My simple yield on cost, it's only 3.6%. And that's because I just haven't been in it that long. The machine needs more years to work. The reason dividend investing works is it needs decades. You saw my yield on cost was much higher on McDonald's, PepsiCo. The reason for that is I was in those since 2011. This one I've only been in since 2017. It takes more time, but you can already see the effects of the dividend compounding work. The company is growing, the earnings are growing, they're passing those earnings down to me as a shareholder in the form of dividends. And so my yield on cost is, on the first tranche, 3.6%, whereas it's 2% if I were just buying net new shares today. I love my PE on cost as well of 17. Now you can see the chart, it's up and to the right, but certainly this stock seems to overreact on good news and overreact to the downside or underreact on bad news. It has some real big peaks and valleys there in the chart, but in general, it's up and to the right over long periods of time. And so that's Starbucks for all of you. Put in the comments below, do you like Starbucks coffee? Do you ever go there? I want to have a meetup there again. I want to do an Idaho meetup. Put in the comments below if you live in Idaho, the greater Idaho, Boise area. Let's go ahead one of these days. I want to meet up at Starbucks like I used to do in the greater SF area when I lived there. It'd be so much fun to know in the comments below if any of you are local. Let me know. It'd be so much fun to meet up. But for now, on Corner Patreon, which I'll link to in the pinned comment below, I'm having Zoom meetups with my Corner patrons over there. They've been a lot of fun, a lot of fun. Anyway, I want to share another stock with all of you today. So I've gone through some food-related stocks, McDonald's real estate-related, Starbucks, I'd say restaurant technology-related. But what I want to go to next is something really fun. I want to move into the industrials because you would think right now, unless there is just the biggest recession of all time or depression right around the corner, industrials wouldn't be doing so well. And I have an industrial, honestly, that's not doing so well, Leggett & Platt. I'm not going to talk about it today. I can't believe they just increased the dividend because their payout ratio is pretty expensive, over 100%. But I don't want to talk about that. I want to talk about Caterpillar, then RAYTHEON Technologies, because those two actually are hitting the ball out of the park. And again, I wouldn't expect this, but they're such quality companies. Let's just do it. Check it out on the screen right now. Caterpillar, a company that I thought, boy, in this kind of economic environment, things would be slowing down. But no, because I took the Warren Buffett approach, because I buy quality, I am buying into companies that are just doing really well. Sales and revenues for this company increased 17%. A mature cyclical industrial company growing 17% at the top line year over year. And you can see this is pretty wacky, but their adjusted profit per share, it goes from 288 to 491, which is, boy, that's about 70.5% growth year over year. Now, there's got to be something more to that. This is a company, obviously, that it is a little bit cyclical. There could have been some one-time accounting things in there. But needless to say, the top line and the bottom line, they're doing just fine. And I want to share with all of you a metrics snapshot. Check it out on the screen in front of you right now. I want to speed this up because I know these videos, they've been pretty long lately. I want to try to keep them a little bit shorter, but let's look at this. So it's 20% off its 52-week high. Nice. And it's trading at a PE in the 11s. This is awesome. So this one looks a little cheaper, and that's why I'm highlighting that here. Maybe I'll buy some more of this. That being said, if we believe a cyclical downturn is just around the corner, that's why it's trading cheap, because those earnings, they could drop pretty fast in being a cyclical company. That being said, so far we're not seeing that. And what's so fun with this company is they're growing the dividend on average by 9% per year. Let's just look at this. I started buying this thing in 2013. So it's not as old of a position as Pepsi and McDonald's, but it's an older position than Starbucks. I'm up 148% on that first tranche in terms of just unrealized equity gain. My simple yield on cost, it's 5.6%. It needs more years for it to compound to get up to that PepsiCo or McDonald's level. But my PE on cost is a staggeringly low 4.8. If I just take my $86, the first tranche, I divide it by their analyst estimate, consensus estimate for 2023 of $11.98, I get a PE on cost of 4.83. Again, it's as simple as that. The reason that dividend stock investing, the way I approach it, works over long periods of time is I buy quality blue chip companies, the best companies around. And I have many videos on how I analyze companies, how I find those best companies, but these are 5 of my best favorite companies. I hold them for very long periods of time because I realize some years will be good, some will be bad. But I realize over the years, on average, revenue will grow, earnings will grow. And then I realize that, okay, if earnings keep compounding and growing over the years, they will keep sending more and more of those earnings down to me as a dividend investor in the form of dividend increases. I have more cash flow that I can use to pay my bills. The system is as easy as that. But it's a bet on the future of the economy and on the future of these winner-takes-all huge blue-chip companies. By the way, put in the comments below how many times did I say today winner-takes-all. I would be curious, but it's probably up there around 10 or something so far. That is the buzzword of today in the video. I have one last one I want to share with all of you, and it is RAYTHEON Technologies. So as you can see on the screen, who would have thought that another cyclical defense company like RAYTHEON Technologies would be doing so well right now? But it is. We hear this bad news every day. And I like that because I think when there's a healthy amount of skepticism, it usually means the market isn't about to collapse. Usually when the market's about to collapse is when everyone has brought it up to levels of irrational exuberance. But right now it seems like there's so much healthy skepticism, which I think is healthy for the market. But RAYTHEON delivered 10% sales growth in their Q1 2023 results, and they have a record backlog of $180 billion. Oh my goodness, what a backlog. What a great thing to see. We can see that adjusted EPS are up 6% versus the prior year. Okay, that's not as exciting as some of these other companies, but honestly, that's all I need. All I need over long periods of time is for EPS to grow, say, 6, 7, 8% per year on any average year, and that my dividend will grow, say, 7% per year on average over long periods of time. That is all I need. But what's also worth noting here is they are repurchasing some RTX shares. I would prefer to see even higher dividends versus doing repurchases, but I know the repurchases, they can help them sometimes because the more shares they repurchase, it saves them the money of having to pay out dividends on those particular shares. And as long as they do it through free cash flow, I'm okay with that. But I want to share some stuff with RAYTHEON. Check it out. I have my Metrics Snapshot on the screen. And I don't have my first tranche analysis here because I need to do some cost basis work and analysis because this one I owned since the UTX days, and then it was spun off Otis and Carrier, merged with RAYTHEON. So I don't really have an accurate representation of what my first tranche was. All I can say is it was a lot lower than where it's trading now. But I'll have to do some accounting work on my end on that. Revenue growth is 10%, as I mentioned. Adjusted EPS 6%. This one is down 8.6% from the 52-week high. Perhaps, at $95, it's not, out of everything I looked at today, the two stocks that I felt were trading at somewhat realistic valuations have been RAYTHEON and Caterpillar. Maybe I'll add a little bit more. We'll see. But basically, the forward PE this year is a 19, next year 16. That's why I highlighted. I think that 16 is compelling if things keep growing. Now, this one has only been a standalone entity in its current form for 3 years in terms of dividends. So the 3-year dividend growth rate has been 7.1%, which is right spot on target. For long periods of time, that's where I like to see it. You can see the chart. It has its peaks, it has its valleys, but over very long periods of time, it's up and to the right. It is growing because the business is growing, the revenue is growing, the fundamentals are growing, and those fundamentals drive increased dividend income for me, the long-term investor. And so I want to summarize everything today really quickly, but before I do that, if you're enjoying the video so far, please don't forget to subscribe to my channel as well. I have new videos on the way all the time. I'm trying to balance my life a little bit more these days. That's why the video cadence has been a little bit slower, and my work schedule, it's been a little bit more elevated recently. So I've been traveling for work sometimes, and I've been working a little bit longer hours, and so that's why I'm a little slower here. But all of the likes and subscriptions mean mean the world, and that's the best way to motivate me to produce even more videos here on YouTube for the community. I love the community. And check it out on the screen right now. This is a synopsis of why dividend stock investing works, in my opinion, how dividend stock investing works. And it's pretty common sense, but I think it's important to remind ourselves that stock values and dividends, they really are a reflection of the underlying company performance. And I invest with a long time horizon. I plan to be rewarded for many years of compounding company growth at a fundamental level. The single most important thing is for these companies to grow their earnings, because if the company performance is up, the dividend is up, and I use the dividend to pay bills. We live in a larger company, winner-takes-all society. Historically speaking, I'm saying that these companies, it seems, they have what it takes to win. These 5 companies that I have illustrated today, even during these difficult times we're in right now, they are winning. And as long as PE is at a reasonable level, I've found that it's difficult for me to overpay for core quality dividend stocks as long as my time horizon is over 20 years. I'm basically trying to say here that I'm kind of like Warren Buffett. I'd rather pay up for quality versus try to find these discount stocks that are really cheap, but the quality of the company is also pretty not so favorable. Now, I like to believe, and I think it's important to share from a timing standpoint, that stocks can overreact on good news. I think Pepsi and McDonald's are pretty expensive here. I think Starbucks is too. I'm not buying those right now very actively, although I'm reinvesting dividends, and they have premium valuations right now. But stocks also overreact on bad news to the downside. We're not seeing too much of that right now, honestly. But once the bad news comes, we're seeing it maybe in the banking sector. And so that's when I like to look at those opportunities to buy core quality companies when there's a little bit of bad news or a lot of bad news, because they'll overreact to the downside. And that's part of how I buy value. Over very long periods of time, the stock market rewards quality. All right, everyone. I really hope you enjoyed the video today. In terms of a full disclosure, I own the stocks mentioned today. I am long McDonald's, ticker MCD. I'm long PepsiCo, PEP, Starbucks, SBUX. I'm long RAYTHEON Technologies, RTX. I am also long Caterpillar, CAT. Also, I'm long Otis, OTIS, Carrier, CARR, and Leggett and Platt, LEG. I give Leggett and Platt a lot of trouble, but hey, they raised the dividend, they increased the dividend. Thank you, Leggett and Platt. I do appreciate that. Before I go today, in terms of a disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my personal journey for fun and entertainment. It's possible to lose money in the stock market. I'm not a licensed financial advisor. Again, just sharing my journey here, all of the ups, downs, the successes, the triumphs, and the setbacks as well, for everyone to see on YouTube. I love you all. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.